Let's have a closer look at the week's business and economic news. We're joined in the studio by Suzanne Haddon, who's the Managing Director of BFG Financial Services. Suzanne, welcome.
Thanks for having me.
Good morning.
Good morning.
Yeah, interesting. We had a bit of a snapshot, I guess, from the IMF during the week over Australia's economy, where it's travelling. It's essentially downgraded our growth forecast from 3 to 2.2%, which is fairly dramatic.
It is dramatic, but I do lean to the side that it's probably a temporary blip. Let's remember that we've had 26 years of uninterrupted by recession growth. I think we've also got to look at some of the positive elements, because the IMF also said that they would think that we would upgrade our growth to 2.9 next calendar year. And the other thing is we're seeing some more positive news from sentiment from the public, from the consumers and business, with more optimists and pessimists. So there are some concerns, but it's not all bad news.
So what have been the key factors do we see as bringing this about, the downgrade?
Yes. So one of the main factors was Cyclone Debbie. It had some very adverse effects on coal transportation. Also the weather was a concern on construction, and that had an adverse effect on our GDP. The IMF are also concerned on a couple of fronts. They feel we have an infrastructure deficit, and living in Sydney, where I see infrastructure being built everywhere, I'm a little surprised with that, but they have said us amongst other countries like Canada, Germany, should be taking advantage of this low interest access to money to build some infrastructure, ports, roads, to support growth in the future.
Have we missed that boat, though, off the back of the mining boom?
To a certain extent, the criticism is that we have missed the boat. I would suspect that politically they're a little bit nervous about saying we're borrowing more, but it's important for us to recognise good debt, bad debt. So borrowing to build something that supports the economy, supports growth, is good debt. Borrowing to pay your day-to-day bills is bad debt, and this would be good debt.
Well, speaking of debt, we've also had the Reserve Bank having a bit of a closer look at what's happening in terms of the housing market, and apparently it's up to a third of borrowers with home loans are said to have no buffer for interest rate hikes. So is that a cause for concern there?
The RBA have stated that they think the level of household debt, coupled with low growth in wages, are the biggest risk to our financial stability. There's been particular spotlight on a type of loan, which is called interest-only loan, and particularly there are circumstances where interest-only loans are worthwhile, but buying your own home and doing an interest-only loan is not one of them.
Well, I guess it's initially attractive, isn't it? Because you're paying less per month. However, you cop it at the end, don't you? When you're selling your home, or you've obviously got to pay the loan out. Suzanne, I was interested to note that it's been revealed that of the big banks, for instance, Westpac, half of its mortgages are interest only.
So the interest only loans across the big four banks does average about 40%. Bear in mind that it has been reducing because APRA, which is the regulator, put the brakes on and said to banks, do not lend more than 30% for interest only loans. And so we have seen a reduction for home loans. But to your point about the repayments, think about a $500,000 debt at 5%. You'd start off paying about $2,100 a month on that debt. After the interest-only period, that will go up to $3,300 a month. That's a nearly 60% increase. The average worker would need about a $22,000 pay rise. And that assumes that interest rates don't go up. So you can absolutely see why the government is very nervous about people doing interest-only borrowing. What about first home buyers?
Well, I do want to also get to another big news item around economics, which was the 2017 Nobel Prize awarded to the American economist Richard Thaler, because we note that economics isn't always a rational business as much as we might like to think. It's wonderful that he's being recognised for the fact that we need to factor in human failings with the way economics runs.
I don't think any of us would be grandly surprised by the fact that emotions affect money.
Well, it's not a perfect science, is it, economics?
It's not a perfect science, and I've said before that markets are driven by sentiments. Some of these things you certainly wouldn't want to catch. I think one they call the hot hand fallacy. And what that is about, it says you believe that whatever's happening will continue to happen. So think about property prices again. Sydney, Melbourne, property's been going up, and the fallacy says you think that's going to continue to happen in a linear fashion for the future. And history has shown you that there have been many pockets, since 2011, where property prices have gone down. And then we've got first home buyers being encouraged by state governments with incentives to get in at the highest point in the market. Concern.
Suzanne Haddon from BFG, thanks very much.
Thank you.
My pleasure.